Hi, my name is Terrell Gates. I'm founder and CEO of Virtus Real Estate Capital. We are headquartered in Austin, Texas, and we are a private equity real estate fund manager that invests throughout the continental United States. What is a little bit different about us compared to most traditional fund managers is we do not invest in the traditional categories or the basic food group property types. We instead focus exclusively on property segments that we found to be more cycle-resilient, or what some people refer to as niche property types, such as healthcare, education, workforce housing, and storage, as some examples. We are focused exclusively on the more defensive or cycle-resilient segments. And, really it's been more than 10 years since we've gotten to prove how resilient these asset classes are, since we've been in the longest bull market in modern history. And I know a lot of people appreciate, at least academically, that these asset classes can be defensive, but they haven't gotten to see it up close and personal. And only those of us that were investing pre-global financial crisis actually experienced how defensive they can be. Well, now that we're in the middle of a global pandemic, we're getting a taste of it again, obviously. The reason these asset classes tend to perform well and tend to have more durable income streams is the demand from tenants sustains in and out of market cycles. And the reason is twofold. Number one, these particular property segments demand is driven by major demographic trends. Things such as the baby boomer demographic, the millennial demographic, the Latino demographic. All of these drive demand for these property types, and then tangentially, what this is what we like to call social infrastructure assets. Healthcare, education, affordable housing, things of that nature, things that you need in good times and bad. So although these asset classes remain very resilient during periods of distress, what we find is there is always distressed opportunities in these property segments. It's usually on the fringes when we're in good times, like we've been in good times for the last decade, and then it increases more substantially when we go into a period of distress, like we're clearly in now with the global pandemic. That's a very different experience than what you normally see from basic food groups, which usually distress occurs in basic food groups where tenancy demand goes away temporarily because you have an economic downturn or you have some kind of socio-political shock or another black swan event that's hard to predict. And when tenancy demand goes away, then the net operating income of the property falls, the income falls, the value of the asset falls, and that's when buyers try to step in, buy at a depressed basis, wait for the economy to reflate, and then the tenancy returns, and then you can grow your NOI and hopefully make good money on that trade. In my property types, it's not about tenancy demand because it's always kind of there. Distress in my property types comes from three places. It comes from either too much new supply at one time, it comes from operational missteps, and that is to say these property types, despite being more defensive, they have more idiosyncratic risk. They have more operational nuance to them than traditional property types. And then the third reason that you might have distress is capital structure. If you have a very aggressive capital structure, either super high leverage, short-term, very aggressive loan covenants, and your business plan goes awry, it's really easy to start having challenges in your capital stack, and you may ultimately have to cough up the asset. So these three factors tend to increase during periods of distress, and sometimes you can have more than one of these. So what we are excited about as a firm is what we are calling the resilient distressed opportunity, distress within resilient property segments. And we experienced this up close and personal during the global financial crisis. And even though this is going to be a very different crisis than the GFC was, it will likely rhyme with a lot of the things that we saw during the GFC. When we think about these property segments and where are the origins of distress, in other words, who are normally the sellers? We think it really, historically, if you look at all the distress deals that we bought through the years, it really typically comes from three types of sellers. Number one, we see distress from mom and pop owners. We see this a lot in the self-storage business. We'll sometimes see it in some of our other property segments. The second sort of category of sellers that we often see are kind of the really large owners, the owners that have really huge portfolios. They usually have a small team relative to their total assets under management, and so they tend to fly at 30,000 feet. It's hard for them to really dive into the weeds. And so even though they might have a little more sophistication than a mom and pop, and they might have more economies of scale advantages, and they might have more resources, they don't really get into the weeds and into the details. So if trouble happens at an asset, and an asset that maybe historically had been stabilized, if that occurs and now all of a sudden it's no longer stabilized and occupancy has fallen, and you've got operational challenges or whatever the case may be, it's really difficult for them to turn it around. And then the third sort of origin of distress typically is from what we like to call more of the generalist investors. And that's often owners or operators that are new to these property types. We've seen a lot of people jump from the multifamily space into student housing or senior living. Well, senior living is the most operationally intensive of all commercial real estate asset classes. So if you don't live and breathe senior living every day and have specialists that understand where those challenges are, it can be easy to stumble. And when that happens, net operating income can fall, and it creates opportunities for others to step in and buy those assets at a lower cost basis. I would say of our targeted property types, some will offer more distress than others. Some will have more distress in the short term. Some will be more in the long term. I think one thing to be mindful of, at least on this concept of distress, I've been through 4 downturns, pretty nasty downturns now, up close and personal. And what I've found is it's usually not the first shoe to drop that's the best opportunity. It's usually the second or the third shoe. So patience is important. I think once you find those opportunities where you have real conviction, I think the key is to have courage to go into those when maybe others are shaking their heads. And I think this is a really exciting time to put capital to work over the next couple of years. No doubt we're going to have, we're all figuring this out too, right? None of us have lived through a global pandemic unless you happen to be around in 1918. I wasn't, maybe close, but I think we're going to be learning as we go. But a lot of the themes from the past during distress periods will probably hold true now. And so I think staying convicted to what you know is very important, especially in this environment. And I think if you do that, I think you will be well served. And I think finding groups to partner with that you know and trust that have been through downturns and know how to be resilient during downturns and know how to seek those distress opportunities will likely serve you well.